Welcome to our Intermediate Trading Concepts series. In this episode, we delve into portfolio management, a critical aspect of successful investing. Effective portfolio management involves creating and maintaining an investment portfolio that aligns with your financial goals, risk tolerance, and investment horizon. Portfolio management is the art and science of making decisions about investment mix and policy, matching investments to objectives, asset allocation, and balancing risk against performance. Asset allocation involves dividing your investment portfolio among different asset categories, such as stocks, bonds, and cash. The process of diversification, spreading your investments across various assets, is key to reducing risk. It's about not putting all your eggs in one basket. For example, during market volatility, a well-diversified portfolio can help mitigate losses, as different asset classes often react differently to the same economic event. Risk management is crucial in portfolio management. It entails recognizing potential risks within your investment strategy and devising methods to mitigate their impact. This might include setting stop-loss orders, opting for lower-risk investments, or regularly rebalancing your portfolio. For instance, rebalancing your portfolio during a market high can help lock in gains and reduce exposure to future market downturns. Portfolio management can be active or passive. Active management involves regular buying and selling of assets to outperform the market. Passive management, on the other hand, focuses on long-term investing with minimal trading, often tracking market indexes. For example, an actively managed fund might try to beat the S&P 500 index's performance, while a passively managed fund aims to mirror its performance. Professional portfolio managers can be employed to handle investment decisions. They have the expertise to analyze market conditions, select appropriate investments, and adjust the portfolio as needed to meet the client's objectives. A skilled portfolio manager can add significant value, especially in complex markets, by making informed decisions based on thorough market analysis and economic forecasts. In conclusion, effective portfolio management is essential for achieving investment goals. It requires a careful balance of risk and reward, continuous monitoring, and adjustment in response to market changes and personal financial objectives. Exciting topics await in our Intermediate Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.